All right, so I am setting out to do a new webinar, but obviously I wanted to get out to you guys first. And you've heard me say this signal a few times. It's called the double D. The it really just kind of stands for doji, but I like to kind of reference it as a double dip. This is important, but most notably, it is a double doji that we look for back to back, and then we want the third bar to extend above the high of that second bar. Now, I know that's a little confusing, so let's talk about it first. Ultimately, I want to see some sort of rejection, right? If the bottom of the bodies are the closing prices of candles, I want to see a specified rejection at or right at the same price where we had the initial bounce. Most notably, I like this indicator at the volume weighted average price. It is this darker purple line here. Now, if I pull some of these indicators, let's just say show the study. Okay, let me pull that off. And let me hide this one. Let me hold that off. Show study. Okay, I'll pull that off. Okay, it'll just be a little bit clearer. What you notice is that you're seeing a reference. It may not be to the exact price, but it's at least to that range that we want to look at. We want to see the actual representative reaction. Now, if it's at the price or near the price, that's absolutely fine. I just don't want it anything too far beyond that particular level of reference. That being said, you're going to notice this particular chart pattern or trading behavior pattern take place, okay? It could be off the lows of the day. It could be after an extended move, after consolidation. I personally want to reference this at the volume weighted average price only. If it's not at or near the VWAP, I don't really want to consider it. I don't want to hold you guys away from it, and if you have greater success, trading off of lows or using it on multiple time frames, which is absolutely available, by all means, you guys do you. However, for clarity purposes, I'm a big fan of this. I'm a big fan of this in several different instances. And in one of those instances, by the way, guys, we just had a huge whopping breakout in go-go, it looks like. Um, uh, uh, there's going to be times where you could reference this even at the 7 simple moving average. After an extended run, you'll see a sharp drop and then a reversal. And then sometimes in those instances, by the time we get our 7 entry, the retrace entry, it's already gone. Okay? So you could kind of look for this pattern to shape up and say, well, it's going to get bullish. I'm going to be prepared. I'll be able to take that there, or I'll be able to take the DD itself. Ultimately, I'm pretty sure there's some reference as a candlestick chart pattern. I don't know. I don't really care. What I really do like is a first bar wider extended range and to have a doji shape. Now, obviously, the perfect doji would be the body closing much higher, and then of course it had a much higher extended tail. But I do want to see a tail. I do want to see that reference, and I do want to see that rejection. The second candle, the low cannot exceed that very first tail. If you're unsure what tails are these thinner lines below the candlestick. The thinner line above the candlestick is considered a wick, right? When you have a candle and you have to you light the wick, and it's at the top of the candle. The tail is the reference on the bottom. These thinner points on a candle basically are representative of rejection. It doesn't matter at what or where, it's a responsive rejection. It's a reaction, off lows, off highs. So I'd like to see that rejection. And then in turn, on the secondary test of that price, I would like to see a rejection at or near that exact same price. Generally speaking, the second candle's low should be within 1 to 2 cent parameter in reference to the low of that first candle. In some instances, maybe it'll be 5 cents. I think that's a little bit too much. I would like to see it actually double dip at that price and show the same type of reaction. The reaction is the key component behind this setup. That's what my reference point is. I have others that I actually want to break out later on this year in terms of other setups that will be similar to this. Okay? That will be similar to this, but just slightly different variations. For now, we're going to reference the double D, the double doji or the double dip. Okay, so as you can see on the third bar, the low is definitely higher, and then all of a sudden it exceeded that high. That's kind of like saying it's time to go. Now this is a bit of a risky trade. Generally speaking, you're going to see it come down and then reverse back up. So it is a reversal type of setup. The reason why I like it at the VWAP, generally speaking, is because the stock has already made a move and will be pulling back to the VWAP and then look to bounce off of that level. This is one of my VWAP entries. I'm working on several others, but for now, I want you guys to focus on the double D. It basically set up an inside bar. The key component here is that this entire trading range has to be within or inside this trading range, meaning it cannot make a higher high, it cannot make a lower low. Does that make sense, everyone? Yes, no, maybe so? Yes? Anybody else? Does that make sense? I don't want to move on if it doesn't. Okay. So we're making this clear. We want this candle to be inside or within the high and the low of this bar, meaning self-contained, quick consolidation, and in turn, the same type of structure, right? The tail. Once the third bar opens up, meaning this one right here, your entry point, generally speaking, should be inside this range from high to low as much as possible. Now, in turn, it can make things difficult. I personally want to be a buyer within 5 cents of the top of that body. Okay? So if that top of the body is difficult for you to figure out, okay, just so you know, it is going to be where your closing price is. Okay? If it's green, it's going to be at the top. If it's red, it's going to be at the bottom. But ultimately, it's that top point of that body that I want. So if it's a red candle, you're going to have to reference it as the opening price. If it is a green candle, you have to reference it as a closing price. If it's a exact perfect doji where it's just like one straight thin line, ultimately just buy it inside that range. I only say within 5 cents of this because I want to give people structure, because they might be like, well, it's valid, so I might as well buy it, and all of a sudden they're buying 15 cents out of the money when that's supposed to be your profit. I don't want that. I want you to try and, let's just say, structure it to buy within this range. Sorry, I'm going to draw a circle from this. I don't know if that looks okay. Yeah, so within that range as much as possible. And most notably, I would really prefer that you buy within that body. Now, you have your entry point and your entry point range. Again, no more than 5 cents extended. Okay? No more than 5 cents extended. If you give me 1 second, I'm trying to reference. Where is it? No more of 5 cents within that price point, okay? So, ladies and gentlemen, if you go to the announcements tab at 8:43 Central Time, from the top, you're going to see a signal that says RBZ double D entry at 234 or lower. Okay? The top of that body was $2.29. So it now makes sense that the entry price was 234 or lower, or within that 5 cents of that top of that body. The stop was at 215. All right. That is going to be based off of that low. Now, I actually should have made it at 213. So that is a mistake that I made just because I was trying to be quick and trying to get us in. The reference of these lows, think about that as your now short-term support level. And so we obviously don't want to put our stop right on that support level. We want to use that support level as our safety net. So if that low is at 215, your stop can be no more than 2 cents below. If you want to have your stop at 214, that's fine. But myself personally, I like to give it a little bit more space. It's not a lot of it. All I'm doing is giving it an extra penny. If you can't afford that extra penny, then you shouldn't be taking that signal. So our stop should have been at 213. Now that's pretty wide, but all things considered is because of the volatile nature of the stock. This particular trading range was nearly 20 cents. So then you have to size in, right? Of course, as it was bouncing around, I got in right around the body price. You could see I entered at $2.30. You could see that it actually breached above, showing a good sign of life, and then it started to extend and it got to 250. And then next thing I know, this son of a gun went to 270 and immediately washed out. So before I even had a chance, all of a sudden we were up basically 40 cents on a reversal play in 2.5 minutes on the signal. The unfortunate aspect was that it washed out for 40 cents straight down to the downside, which kind of sucked. Now, all I'm looking for is this: the two tails, the opening price within this candle, and then, of course, we pray that it extends up. And if it does turn down, at the worst case scenario, it bounces. Let me draw that right here. Sorry. That it finds continual support at this level, bounces up, and then, of course, does this. Now, this is the best case scenario in this situation, of course, that we get immediate rejection and then we get immediate reference to the upside and blowout buying. I would love that to happen every time. Of course, that's not going to happen. It is a bit risky. But in turn, if you think about the conceptual idea of this, we're seeing reactive trading at a price point of reference. We're using multiple layers of support, the VWAP, and then, of course, these lows as our support level. And if the stock is above the VWAP, generally speaking, it's made a bullish move. We're looking for bullish sentiment, which we're going to get with this reversal. And, of course, God willing, if the reaction is strong enough, we get the boom, the strong bump, the strong move to that upside. It wasn't a significant winner for me personally. It was good, 14 cents. However, if I actually was reactive enough, it could have been the biggest trade I've had this week. The risk allocation was a little bit wide, but that's what happens with volatility. This was the boomer that I was looking for. Next up is going to be the three-stepper. And I'm almost thinking that maybe I am going to do a separate video on the three-stepper here. But then I also don't want to kind of flood the documents tab with videos. Maybe I will do this. I'm going to do a secondary video here shortly. And if we use that secondary video, I am going to use it for a completely separate setup. In the meantime, folks, I am going to stop the recording of this video. I want you to just keep an eye out for this pattern. I personally have been working on trying to design the platform to recognize this pattern, but unfortunately the platform just can't be tweaked enough to find that actual reactive pattern. I'll tell you right now, as soon as it takes out that high of that second bar, it's basically saying go. That to me is what you would consider that U reversal in play, but happening very immediately, but not in the shape of that V reversal that everybody looks for. I love this pattern. It probably comes up a couple of times a day in some of the most healthiest names that we look at on a daily basis. And unless you are absolutely looking for it, which generally speaking you should be once the second bar takes place, you'll never know on the first bar unless you're, oh, it's coming to the VWAP and it reacted. Boom, now you know you should be looking for that double D or the double dip. If the second bar reacts in accordance, take the trade. We'll see how it goes. Mind you, ladies and gentlemen, for those that are in the room now and that are going to be listening to this video in the future, practice, practice, practice on a simulator. Study what you should be looking for. Ask me questions in that reference. Do not try and take on something that you are unsure of or just do not have down pat as of yet without practicing with paper trades. Fake money, not real money. You guys have already paid enough money in terms of education. Don't pay more if you do not have to. All right, folks.